Good evening, everyone. Thank you for being here. خاصة second day, 5 p.m. I really appreciate you guys coming. So I'm Huda Al-Lawati from Aliph Capital, and we're holding a masterclass in private equity. This is a intro private equity basic class, so if any of you already are in investments or work in private equity, you might find it boring, and so please feel free to leave if you do. But honestly, the purpose is just to give everybody an overview of private equity, how we think about deals, how we think about the business of private equity, and just put it in a simplistic manner and maybe color it with some stories that we've seen. Obviously, FI Institute would kindly had us host this class, which we really appreciate. And this is just to reiterate that this is for young professionals interested in learning about private equity or older professionals looking at changing careers. I'm Huda Al-Lawati. I'm from Oman. I've been doing corporate and private equity for 20 years. I started my career at Schlumberger. I spent 12 years at Abraj. After that, I was the chief investment officer of Savola. And I spent some time at an emerging market PE called Gateway Partners. And about this time last year, actually at the FII last year, I announced that I would start Aliph Capital. And yesterday, we announced that we did our first close. So very happy to be here. I've been involved in a lot of Middle Eastern businesses. Thank you. Thank you. With me is Farah Al-Mazroui.
Hi, I'm Farah Al-Mazroui. I'm from the UAE. I have 12 years of experience in the investment sector, and I joined Huda back in October, so day one. So we're very proud that we raised capital in the first year since we started.
So the sections today are basically just an introduction of what private equity is. A quick run through what the business of private equity entails. So I know people talk a lot about the investments and what we invest in and what we sell, but we also run a firm at the end of the day, and we're founders and entrepreneurs that also have to manage our own business. And finally, Farah will take us through the investment process and the key areas of focus at a high level. Starting with what is private equity. Asset classes differ on many fronts. They differ in the level of return you can make. They differ in the level of liquidity, how quickly you can encash it to buy food, basically, and how much risk there is, that whether you're going to get your capital back or not, whether you're going to have losses or not. Very high-level baskets of asset classes are cash, which is obviously extremely liquid. You don't make much return on it. In fact, if there's inflation and or currency devaluation, you can be on the wrong side. And it's not very risky. Fixed income, less liquid because you have to trade those fixed income assets, but also less risk, and you make a small return, or can make a small return depending on where the yield curve sits. Equity, which represents the most common investment, is public equities, where you basically invest in shares or in mutual funds or ETFs that trade in share. And obviously, these are traded on markets and therefore have a level of risk associated with them. They have a level of liquidity. You need to find buyers to get your money, and but you do have the option to earn more return than you would in fixed income. Equity can be in any sectors depending on what's listed on the stock market, and most people have some level of exposure to equity. And depending on where, U.S. markets are the most liquid. Some emerging markets can be public listed but not as liquid, so you need to take all of that into account. Finally is the asset class of alternatives, which entails real estate, hedge funds, private debt, venture capital, and private equity. So this, of course, is the least liquid of asset classes. It has a potential to make the highest returns, but it also entails a lot of risk. Types of private equity strategies vary. They include buyout, which means I go and buy 100% of the businesses, privately owned businesses. It's a very common strategy. It's actually one of the earliest strategies in the West. And this is easiest to do if managers and owners are separate. There's venture capital, which you see private equity and venture capital, but from a categorization perspective, it is part of investing in private businesses. Growth capital is when you invest money into businesses to support the growth of those businesses. Turnaround requires special capability, but this is when you invest in private businesses that need operational change. They might be loss-making. They may need a management change or strategy shift. Fund of funds, these are managers, or these are funds that invest in other funds. So there you basically, investors typically pay them for selection. And finally, secondary fund of funds who trade in private. So if I invested in private equity fund, I can sell that ownership to somebody, or I can buy from funds. This is the variation by, or the categorization by strategy. Private equity also varies by fund type. The most common type is a blind pool. What does a blind pool mean? It means there's a manager, and investors give us money to invest in private businesses without having any say in what we will invest in or what we cannot invest in. It's a blind pool. They're trusting the management team and the track record or the company who they're giving the money to. Deal by deal is when I find a specific company and I create a private equity style fund, and I go raise money for each deal. And there the investor is basically deciding whether they want exposure to that specific deal. And therefore, the focus is more on the deal, less on the track record of the business and the company. Pledge fund is a hybrid model. This is when I go to investors and they agree that based on my track record, they broadly are willing to work with me in the assets that I find. But they will not, it's not a commitment, meaning that when I find investments, they will choose to either opt in or opt out. And finally, there is managed account. This is when there is a pool of private assets owned or a single investor that wants to have a private portfolio, but they want an external manager to manage their private assets, and it's called a managed account. The reason people like private equity, because obviously you could invest in, as we said, in equities in the public markets, have more liquidity, less risk, easier encashment, and your money is not stuck for a long time. Private equity money is 10-year money, which means you cannot ask for liquidity for 10 years, 8 years, depending on the terms of the fund. But it is still a very coveted asset, and the reason for that is, one, in the public markets, you only have access to listed companies. So you can invest in Mara'i or STC because they're listed on the stock exchange. But if you wanted to invest in, let's say FII was a company, the only way to do it is to go through owners who own it and gain access to it privately. You would not be able to gain access to it publicly. The other reason is that you get attractive returns. Historically, private equity tends to outperform the stock markets. You're taking higher risk, but it has outperformed the stock markets and the S&P 500 historically. Now, that's not true for every time period. It's not true for every market, but on a broad time frame, especially in the US markets and the developed markets, it is a fact that private equity outperforms. Private equity is also interesting from a developmental angle, and this is why you see a lot of focus, particularly today, from GCC governments on private equity, is that it facilitates growth and innovation. If you are in the stock market, I used to run investor relations at Savola when I was there. Every quarter, you are answering a room full of, a room like this, where I'm presenting results, and people want to know, why did this go wrong, and why did this go wrong, and why are numbers down? Sometimes when you are taking on a strategy or an initiative, it has a J-curve, which means things look bad before they look good. It's hard to do that in a public market setting where you're accountable for every quarter. Private equity allows for that. It allows you to invest in innovation and growth without the scrutiny and the quarterly pressure of stock markets. And finally, private equity is very bespoke. It's, you know, you want to start a business, or you have a business, you want growth capital, but you want it in different tranches, you want it structured partly as equity, you want some downside protect. There's a lot of things that you can do in the private markets. We can agree the terms, which you can't. In the stock market, I buy shares, and my rights are the rights of any stockholder. In private equity markets, I can invest, I can decide or negotiate that I want certain rights, the management can ask for certain authorities, and we can create a bespoke deal catered to the situation that we want to finance. So that's broadly what private equity is. I'm just going to pause before going into the structure to just see if anybody has any question of what is private equity or what it entails. You cannot have any questions. All right. This is just a very simplistic view of the legal form of private equity. The structure that came up in the 1950s, I think, in the 60s in the US, basically it's what's called a GP-LP structure. A GP is a general partner, and an LP is a limited partner. It's just a private equity terminology for investors and managers. Limited partners are investors, sovereign wealth funds, such as PIF and ADQ, insurance companies, pension funds that invest in private equity funds. GP, the general partner, is people like us, fund manager. They're also called fund managers or the private equity company. The private equity company or the general partner forms a fund, which is an actual legal structure under many jurisdictions. And limited partners put money into that fund and sign a LPA, which is a limited partnership agreement, or a subscription agreement where they sign up to the limited partnership agreement. And what they agree is that the fund will pay the general partner a management fee and a profit share, which is called carried interest. The fee structure in a typical PE environment is what they call 2 and 20. 2% management fee on the assets and 20% of the profits. And it's usually subject to having a minimum level of return known as the hurdle rate, which usually is 8%. The limited partners for putting in capital get first their capital back, then profits up to the hurdle, and then the profit is shared on an 80-20 basis. Under the fund, the general partner controls the fund, and from that fund, they buy companies, and they run those companies. And like we said, the strategies of private equities differ. Active fund managers will be extremely involved. Others will take, some have more minority strategies where they make good selections and good teams and take a little bit of a less active role. Others do turn around where they change everything in the business. So that varies by strategy. A typical fund life cycle, I would see it into two key areas. One is the investment period. The second is the harvesting period. Like I said, the private equity term, the typical term is 10 years. You typically have 4 or 5 of those years making investments known as the investment period. In that, you first raise capital, which is the most important thing, because obviously if you can't raise capital, you have no capital to deploy. And then you invest that capital. You manage the portfolio that you create, and finally you sell it and return money to the investors. That initial phase is known as the investment period, and in that you have either committed capital, which is capital that somebody has signed up to, giving to you, or you have invested capital, and together those two are known as assets under management. You'll hear AUM a lot. Uncalled capital or committed capital that hasn't been used is also referred to as dry powder, commonly, which you will see in the news a lot. Once you pass that 4 or 5 year mark of investment period, your job is to manage the portfolio and achieve an exit for your business, for your portfolio companies. These exits can be selling to another private equity fund. They can be selling to a strategic. I'll give you the example of Middlesex University. It's a university in Dubai that was bought at the time by Aliph Capital, which was at the time a private equity firm. And it was later sold to Amanat, which is a PE-style listed company. So it was sort of a listing, and the business became as part of that listed. So you can go through different iterations. RMX was the first private equity backed IPO in the Middle East in 2004, and this was actually listed on Nasdaq, taken private, and for 4 to 5 years, and then relisted on the DFM in Dubai as the first PE-backed IPO. Other exits are strategics. The strategics are often interested in companies that have reached a certain scale. Private equity can take a private business, help the governance and the scale up and get it to be interesting enough to strategic players in the industry. Just maybe one thing on realized investments. Realized investments is what for a private equity really create your track record. And if you remember what we talked about, the blind pool and people backing you in your private equity fund without knowing what specific investment you're going to have, this is what they look at. What is your track record? How much money have you given back? How much money have you returned? Now, that's not to say that you can't do this. It has to start somewhere. So there are people that will focus on what they call newer emerging managers. But realized investments is really it's the goal. Get to a strong level of return. And in private equity, you're usually targeting, returns of over 20% and net returns to investors in the high teens, which is significantly more than what you could get for fixed income or even the stock market. I'm not going to spend a lot of time on this because the session is not long enough to do that, but I just want to talk a little bit about terminology, some key terminology that you should know after talking about private equity in regards to fund flows. So investors give money to the fund, and when they actually give that money, it is called paid-in capital. Funds give money to portfolio companies or either buy portfolio companies or invest into portfolio companies, and that is their investment cost. Once you sell a business or you have an existing business that pays a dividend, that flow, which is E, is the investment proceed and returns that flow back to the fund, and when you give that back to investors in a distribution, that's distributed capital. These terms are important because they drive a lot of the terminology like distribution to paid-in capital, value to paid-in capital, and all these terminologies that are very, very important to investors that if you do a more detailed session on private equity, you'll get to, but you can look them up. CNF are in a different color because they represent value that is not cash. So F is the book value of investments that has not been realized, but is the net asset value or how much the business is theoretically worth. And that is the ownership of the fund, so it's therefore the what they call NAV or net asset value of the fund. And investors also look at what they own in terms of fund book value. I will skip this because it's a lot of math, but it's basically more of terminology. This is just to give you an overview of what private equity is, who the different players are, the general partner, investment manager, the investors, and the fund flows. The business of private equity is is when we are, like any other company, and what are our costs and what are our revenues. If you remember, we said that the private equity firm gets management fees, typically 2% of either committed capital or assets under management, depending on whether you're in an investment phase or harvesting phase, and carry, which is the short for carried interest, which is a 20% profit share that you get. This entails a lot of patience. A private equity firm does not make money in 1 or 2 years. You typically buy a company, hold it for 3, 4, 5 years, add value, then find a buyer or do an IPO, and your carry really comes in after you've returned all the capital. So there's a long wait to get to carried interest, which is very important because this is why, one of the reasons why private equity is very successful as an asset class, because you get high caliber investment managers and professionals who are fully vested and fully aligned with you. They are trying to make you money because they only make money after you make money, and they make 20% without putting capital. So it's a big chunk of money, but it entails giving you your money back and a hurdle rate back, which is why it's successful as an asset class. The cost structure of a private equity firm primarily is composed of people. These are qualified investment professionals who have investing, management, valuation, experience. This is the make or break of any private equity firm. A good team is a good firm. A bad team is nothing can happen, right? Because at the end of the day, you have to manage the assets. And your typical career path into a private equity is comes from things that private equity doesn't typically take out of school. Typically coming out of 3 to 5 years in investment banking or similar tracks, and increasingly with active funds, they also hire from corporate and from consulting to bring the value add or operational side of things. Other overheads include things like rent, IT, services, compliance. Private equity is a regulated activity. You're managing money. You would be managing a regulated fund, whether that's a CMA regulated fund in Saudi, ADGM regulated in Abu Dhabi, FSA regulated in the UK. But you are managing money, and therefore you're subject to a lot of compliance, a lot of KYC checks, a lot of anti-money laundering checks. And to do that, there's a cost associated with it. So it's an important cost item. Setup. Unlike coming up with an app or a product that you can start with the colloquial garage, you can't easily do that when you're managing money. You do have to go through a setup, create a regulated structure. People like us who manage money are authorized under different regulatory structures, and that you have to go through a setup in a regulated environment to achieve that, and that is also costly. And finally, communications and fundraising. As you travel, meet investors, as you maybe hire placement agents, you will incur costs, which creates the P&L. So obviously you have management fee, you have all these costs. There's a level of assets under management which allows you to become profitable, but the best business model in private equity is where your management fee covers your costs and maybe a little bit more to allow for growth. And the bulk of your money is made through carried interest and the allocation of that carried interest to your team. Investors are becoming increasingly savvy about that. It used to be that carried interest used to go to founders and 1 or 2 people, but increasingly investors will look at how the carried interest is allocated, who is getting that money, and whether or not the entire team is incentivized as it should be. So that's really the business of private equity. Getting to the more sort of day in and day out operational job is basically making the investments. So I'll hand over to Farah for that.
Thanks. So as Huda mentioned, this is really for people that are just starting in the industry. So take that into account, and we're happy to sort of address any questions you have or any particular topics that you would like to dwell on towards the end of the session. So just generally speaking about the investment life cycle in PE, where we start with sourcing opportunities, and that's typically done either through your own network or through third-party advisors, and that includes a large investment bank or local investment banks. A lot of the time, I also sometimes I go to the supermarket, I like a product, I always look where the product is made, and if I find it's in the GCC, I get super excited and try to find out who owns that company and go approach them directly and be painful till they say yes to me. Once you source the opportunity, you typically sign an NDA with a company, and they start sharing some information at a very high level stage. They might share a teaser. You can send some basic information request list, meet with the management team, and what they expect you to do is to sort of submit a non-binding letter of intent, just so they align on valuation. But before drafting the non-binding offer letter of intent, what you typically do is that you would really do an external your external research, which includes doing research on the industry, on the market itself, how it's growing, competitive market position of the company, dwelling down on company specifics, the company's operations, the business financials, the management team, and start sort of thinking of the investment rationale. And in parallel, while you're also doing this, you're also looking at valuation considerations to submit the non-binding offer. And that entails looking at trading comps. I'm going to speak more on valuation in the following slides. And then there's due diligence. That's when you start sort of incurring costs and hiring external advisors to help you. In the following slides, I'll also talk in more detail about that. And then finally, execution. And then there's also portfolio management, where you need to report on a quarterly basis the performance of the company and on an annual basis. And then finally, exit. I'll touch upon each of these in the following slides. So as I mentioned, sourcings, you usually go to banks or through your networks or like ideas that you develop.
Yeah, and if I may just on that slide, ideation basically is that it's not enough for investors to bring you, if you rely typically on investors, you'll see a lot of shopped around deals. Networks are good because people, are looking for, and they're looking for capital and they know you or they trust you or think you can be a good person, they talk to you or you find something interesting. But ideations where you look at a market and you say that, look, I think that Saudi is going through this amazing boom and there's a lot of activity in the tourism space, government is focused on it, there's opening up, and so I think there'll be things that are interesting in the tourism space. Then you map out that landscape of tourism and you look at, well, what are the different businesses that I can invest in to benefit from that? And then you see, okay, in these businesses, who are the lead players in our market today? Are any of them private and available for investment? Are any of them in need of capital? Are there anywhere I can specifically add value? So, a good example of this is on the back of what's happening in the region, in Saudi, going to find hotel operators and saying that, well, actually, hotels here, there are some groups, but, there's a huge capacity to be built up, and we can put capital towards that, but we can also bring operators from our international networks to bring. So you can start having ideas of what you can do, and then map out and start using your network to find the people who own the businesses that could be of interest to you.
The second step is on the investment rationale and hypothesis. So there's a research side of it, and then there's the number side of it, where you build your financial model and assess the numbers that the management gave you. On the research side of things, the first thing is macro, so looking at the macroeconomic conditions of a country, and within that, it's stability, the political situation in a country, and also assessing currency. So, for example, our current fund, Aliph Capital, we're mostly focused on GCC, so we're pegged to the dollar. But for example, in countries like Egypt, where the country has experienced devaluation multiple times, so that's like a key risk when making an investment.
So an example of that is in 2007, I invested in the largest healthcare business in Turkey. It was $1 billion transaction, and they actually exceeded their business plan. But we still made less return than we intended to, because we had assumed in our analysis that the currency is going to devalue by 5% per year. But it's Turkey, so it devalued faster than that. So you take it into account, but obviously you don't have a crystal ball. But it's very, very important to keep that consideration in mind.
The second bucket is industry. So we're looking at the total addressable market, looking at the growth prospects in the industry, how fast the industry is growing. Regulation, this is quite important. It's also an external factor. Say, for example, in cases in the UAE, industrials that export to Saudi, recently there was like a tax levy, so things are becoming more expensive. And so this is something that you really need to take into consideration when doing an investment.
Another example is the Human Resource Development Fund here, for example, the HRDF. For a lot of sectors, there's a subsidy you get from HRDF, education being one of them. And if you build your models based on that, you better be sure that that's continuing, or do diligence and figure out up to what year it's continued. Because if you put in a subsidy that is going away, or forget a tax that doesn't go away, your returns will change drastically very easily.
Another example on this is also on K-12 schools. Like in Dubai, it's highly regulated, so there are caps on how much you can increase tuition fees every year. So fragmentation some industries are highly fragmented, so there are so many players. So one thing to assess is how strong the target that you're looking at, how strong are they within the market, and is there a way, like one thing that we do consider, is there a way to consolidate the sector, and how can you consolidate the sector? Potentially through bolt-on acquisitions. The maturity of the industry and the competitive landscape, I touched upon that as well. The third bucket is looking at the company itself, looking at operations and the company's financials. So one of the key things is as you come to put your business plan together and want to expand, whether expand a certain product or expand into other markets, the key people that will deliver on this is the management team. And the key people that set a culture within the company is the management team. So you really need to do proper diligence and ensure that you're happy with the team that you put in place, or the existing team within a company. Brand awareness is also important, how the brand is perceived in the market. Location of the company, so sometimes there are instances where you want to sort of expand businesses into other markets. What are the key attractive markets that you want to expand into? Market share, is the business a market leader within its segment? The financial track record of a business, so assessing a company's financials, top line growth, how has the business fared in terms of like top line, whether it's a volume play or a price play, the scale of the business, and the cash generation. Typically, when you're looking at the financials of a company, you would look at top line, you would look at margins, how margins have performed historically. If margins are declining, you would sort of raise questions like the reason for that decline, and you should get comfort on how you can sort of expand margins going forward. You look at the working capital of the business, which how fast can you turn the business? How fast can the business turn operations into cash? The cash conversion cycle of a business.
And I think one thing to note on the company side is that it varies by industry, right? In consumer businesses, brand and consumer perception of brand is very important. So if you're buying if you're investing in Mara'i, let's say it was private, obviously one of the most compelling things for Mara'i is its brand, followed by its quality or together with quality of its product. In certain sectors, for example, in financial services or banking, licenses are very important, in insurance, because it's not easy to get those licenses. So having that license in itself has value. Scale is very important in businesses that have very high fixed costs. For example, in factories and industrials where you're putting up plants. So if you have a big scale and you're already a sizable player, that helps you a lot in businesses like that. So this does vary a lot, but I think the one thing that is a definite constant is the team. Every business in every sector, the team quality is extremely important.
You would also look at growth opportunities, so expanding locations, expanding into other countries, expanding into new product segments, expanding capacity if it's a manufacturing facility. You would also look at the cost structure of the business, how efficient is the business, how much scale can you achieve, Also, you would also assess the technology part of it. Is there any form of technology that you can implement to improve operations? And then
just on growth, maybe I think an example of something in our pipeline is we have a business that's in apparel, and it's in across its country, but it's only it has a very small e-commerce segment. So for just the concept of adding e-commerce can be a huge growth factor. They're also in one country, but not in other GCC countries, so expanding the footprint can be very big. Efficiency is also something they now have several warehouses and old school logistics system, but putting in a distribution system, creating efficiencies can be another lever for growing their EBITDA margins.
And the last bucket, and I think it's the most important, that is exit potential. You really need to study this very early on when making an investment. The whole point in investing in a company for a private equity firm is to eventually exit and make returns. So you need to assess the exit potential of the business by looking at exit avenues. It could be to a strategic buyer, it could be to another financial sponsor, or an IPO.
Hmm?
It is the most important question from clients. What's your exit strategy? Oh.
Just for everyone to hear.
I said, actually, it's the most important question for the client. What's your exit strategy?
No, absolutely. And because investors, they give you money because they want 2 or 3 times their money back from you. They're not giving you money to pay you a 2% on how much money that you're investing. So you're right, Haifa's active in fundraising, and that's why she knows that investors, that's what they ask for when you go to raise money. It's what do you, how will you exit this business? And actually, the downfall of any private equity firm has not been the inability to invest. It's been the inability to sell and return capital back to the investors. Oh, yeah, sure.
Yeah, how do you determine the best pathway for an exit?
How do you determine the best
pathway for an exit?
So I think I'll tell you about what we do, right? So we have, as part of our process, exit is not only part of the initial investment rationale, it's also part of every quarterly reporting update on what exit happens. But the initial rationale, you look at the sector, like, well, okay, this sector, we're investing in a business that is a relatively nascent sector in the GCC. If we were 2 weeks from now, I would have been able to tell you what it is, but I can't because we haven't closed it, we've just signed it. But this is a sector, when you look at the mergers and acquisitions activity in this sector around the world, it's been a lot of private equities have bought into this sector. Strategics are acquiring businesses in this sector, but by strategic, I mean that there's multinationals that buy into the sector, and they buy it from private equity and from private owners. And there have been very successful IPOs in this sector. So the global M&A activity and IPO activity gives you a good sense of the interest in this business. Then you look at the growth and return potential of this business. Any business that is growing at a healthy rate and has a good cash flow and good return generation is generally a good candidate for either an exit or an IPO. The way you determine it is that you look at the profile of the business. So a business that is more of a dividend business, i.e. you feel like you have capacity, you build it up, you get it to profitable level, but beyond that it starts sort of maturing, going at very low rates. That business is typically not a great IPO candidate. That business is a good private sale candidate or trade sale candidate where families or groups want to buy it and have a good yield. If it has a high growth potential, then it's a good IPO candidate. Precedents in the stock market are important. People love doing it, but I generally prefer not to be the guinea pig of the market. So I would rather be the third business in my sector listing on the stock exchange, not the first one, because you don't know how the stock markets react. So, just looking at what's out there in the stock market, the interest of the multinationals, the interest of the strategic players is avenue. But one important element is a good business is always interesting to somebody, right? People say, oh, there are no exits, the IPO markets are shallow, et cetera, et cetera. The reality is if you invest in a business and build it up, not to flip it, i.e. you don't do something that gives you good numbers for 3 years and then there's no sustainability. If you build it up for the future, there will always be buyers. We are today in the Middle East blessed with the fact that our IPO markets have become much, much deeper than they have been, and there's a lot of focus on growing them. But it's important as an owner to keep revisiting your IPO story, meaning that every quarter you don't just discuss performance, you don't just discuss quarterly number, you say, okay, are we on track for an IPO? IPOs are not the best avenue for private equity sometimes because you can't sell actually in an IPO as a big owner. And so you do look at trade sales as well. But yeah, I think that it varies by situation. Skip the next one.
While you're developing your investment thesis, you also need to assess the risks and get comfortable with how you can mitigate that risks. This slide just has some examples of things that we've seen. And it's really important to get comfort on how you can mitigate such risks. In terms of valuation and structuring, the most common way of valuing companies that we've seen for mid-market segment in the GCC is through comps, whether it's trading comps or precedent transactions. And you would also look at over the cycle comps, so you wouldn't look at comps only as of today.
And that means price to earnings or enterprise value to EBITDA.
EV to EBITDA. You would look at it over a period of time just because where the market is at today. So you might be looking at valuation, and it might be an all-time high. So that's why you would look at it over a longer term period. DCF is typically you would use it as a complement to your comps. Typically, more strategic buyers would use DCF just because they can realize synergies, and they would use that as a premise for evaluation, and that's why you also see on precedent comps in terms of EV and EV to EBITDA. Strategic buyers are willing to bid a higher price.
Just very quickly, that means that Mars is willing to pay a higher multiple, or should be willing to pay a higher multiple for a chocolate business than a private equity, because Mars can actually take away a lot of the cost. And it's a very, very important indication. On structuring, just because we're short on time, a lot of this, each of these can be a whole masterclass. So we're not, we're brushing through it, but happy to answer questions after. Private equity typically means that I buy shares in a company. So I own shares, and it goes up, it goes down, I lose money. There are a lot of other ways of structuring investments, and what this means, and this is the benefit of private equity because you can do this, is that trying to solve a bid and ask gap, meaning that if Farah selling her business for 100 and I'm only willing to buy it for 80, but we still really want a deal, we can find ways to close that gap. One way would be earn-outs or clawbacks, which means I tell her, fine, I'll give you 100, but I'll take 20 back if you don't make the numbers that you're supposed to make. Or the other way around, I'll give you 80 now, but I'll give you another 20 if you make these numbers. Minimum return. I can say that, look, I will give you 100, but if you don't make 15%, then I'm going to take it from your share. Buybacks. This is something that does. Sometimes if I think that the exit risk is high, but there's an interesting investment, meaning I cannot find that precedent, I can't see a viable market for it, I say, okay, look, I will invest in your business, but you have to buy it back from me in 5 years' time, or I have the ability to sell it back to you at a certain number, and so on and so forth. In the interest of time, we will run through that.
This slide just talks about the due diligence process. I think the key ones here to outline are legal, and that's typically like reviewing like material contracts of a company, reviewing the articles of association of a company, making sure that the company has the right licenses in place. Financial, the key things there is like in terms of DD, you would look at the company's 3-year performance, and the key things that you would get out of it is basically the quality of earnings report. If there's any normalization adjustments to the EBITDA number, ensure that you also have a view on a normalized working capital of a business, any net debt adjustments. And the other one that you also might consider is the commercial. As you build your model, you would typically, if you do engage with a commercial advisor, they would give you a sense of like what's reasonable for you in terms of market share, in terms of market growth, how much market share you can capture, and that feeds into your analysis. I'm not going to touch on the other points just for the purpose of time. I'm just going to move on to the next slide.
Look, I think since we have a minute left, I think we'll try to end it here by saying that the actual process of the deal involves signing a share purchase agreement. If you're entering into partnership with existing owners or new owners, you also sign a shareholders agreement. And finally, you actually effect the transaction by taking over shares, registering ownership with the relevant authorities. I think that's it. And after all this, we focus on portfolio management.
Yeah.
Again, that's a whole big section, but what we try to do is make sure that you have a 100-day plan. When you go into a business, you need to have a plan on how you're going to take over and what are you going to do in the first 100 days. If you get that right, you basically are on your way to achieve what you call the value creation plan, create an attractive asset which is exitable, and realize the investments. Please.
I didn't see on the structure debt, equity,
Safe notes?
Yes.
Yeah.
Is that something that is not common in this area?
It does. So Safe Note is a very venture capital term. It was actually Y Combinator innovation. But now we see the private equity venture capital lines blurring, but Safe Notes have been done in private equity as convertibles, right? They've just been called Safe and Kiss Notes through the Y Combinator and the venture capital. All that means is that I'm investing without wanting to take too much of a view on your valuation. I would rather tell you I need to make 15%. So I will take a discount to whatever the next time you raise money. It's more in the venture capital space.
And also, how do you manage? They pay you a fee to manage the fund?
Correct.
What happens when you don't return as expected? Do you get like a penalty, or do
No.
That's a risk.
That's a risk. So that's why it's hard to raise money, and that's why it's important for investors to diligence and look at the exit capability and the investment capability of the team, because the 2% is the cost of doing this activity. That we get penalized by not having an exit and therefore never ever being able to raise money again. But the 2%, because theoretically that money should go into costs anyway. You're not like getting rich on that money.
Okay, thanks.
You're welcome. Any other questions? Great. Thank you, guys. Sorry we ran through it.
Thank you.
In our defense, it was originally a 90-minute session, so great. Thank you.
Thank you.
Thanks.